Hello everyone, welcome back. I got some really good ones for you today on this Tuesday, May 20th, 2025. A lot's been going on with the markets and the economy. That's what we're gonna be focusing on for today's video, so welcome back. Glad you made it, glad we could hang out together. You know, I'm sorry I left you guys hanging there. It's been a while since my last video. The last video was about a month ago on April 19th when we were staring into the abyss, you guys. We were talking about, I don't do buy or sell recommendations on this channel, but I was saying the book says buy. The book said we're at the line of a bear market, at the line of a recession. The book says buy. Don't buy all at once, but start tranching out your buys, buy quality assets until we get out of this bear market, until we get out of this recession. You're gonna be all right. Boy, did we V-shaped recovered way faster than I even thought we would have recovered. So been a pretty wild ride, but it looks like in the last video we called things correctly. Go ahead, go back to the last video, listen to it, and ask yourself, if I had known that at the time, you know, would that have helped, you know, inform my decision making and help me make the right call? I'll leave that to you, but it's looking like we nailed the last video. And for that matter, guys, we've been printing since the inception of this channel, right? So, you know, take it or leave it, right? I'm not telling you what to do, but I'm telling you what I'm doing. I'm telling you kind of what I see going on, and it looks like you know, our track record kind of speaks for itself. At least I hope. Let me know what you think in the comments. Have I been over the target? You know, if not, let me know. You know, I certainly don't know everything. I'm working on very incomplete information, like you are, like markets are. But yeah, let's get into it. So what has changed over the last few weeks? Well, it looks like that negative quarter of GDP we had was just an apparition, because if you look at how GDP is calculated, imports skyrocketed, and when imports skyrocketed, that gave us a negative quarter. Imports about a month and a half ago skyrocketed because Trump came out guns a-blazing with all these really insane tariffs, and that totally spooked the global economy. It looked even for a minute like global trade was going to break down. And when large companies see that these tariffs are about to happen, they import now. They call China and get their iPhones over here before the tariffs hit. So we saw a lot of just a huge spike in imports. That gave us a negative quarter of GDP. But again, it's not to be taken as like deflationary and recessionary. It's more like how GDP is calculated. That spike in imports gave us a negative quarter, and it doesn't look like we're going to have negative quarters going forward. So it looks like we're, you know, out of the woods, guys. It really does. Things are looking bullish. So a lot of people would say, nope, this is a bear market rally, we're about to roll back over. I'm not necessarily in this camp. I generally think we were going through it a few weeks ago, a month ago, and now we've seen stability come back into these markets. So recession odds have fallen precipitously. In the last video, guys, JP Morgan was putting odds of recession at like 60%. Since then, that number has fallen below 50. Goldman Sachs had their recession probabilities at about 50% a few weeks ago. It's down to like 35. So the big banks, now that Trump has put out the fires he's started with his incoherent trade policy, like that was on him, but it looks like he's put out the fires that he started. The bank's kind of giving him the nod of approval. Recession odds are now below 50%. Tariff drama is subsiding. We also have quantitative tightening, looks to be slowing down. So you have quantitative tightening and quantitative easing. Quantitative tightening takes currency out of the game, so it's very deflationary. It withdraws liquidity from the system, whereas quantitative easing, QE, is stuffing currency into the system. It's very inflationary and very stimulative. Well, the Fed, with regard to their balance sheet policy over the last few years, has been doing quantitative tightening, but they're changing the way they do quantitative tightening, and that can be seen kind of like a QE Lite. And so I'm here to coin the phrase QE Lite. That's what we're doing. We're not doing regular QE. We're not doing full-blown QE, but we are doing QE Lite, because normally when you do QT, what the Fed has been doing, when the Fed buys a bond, a treasury, from the Treasury Department of the US government, and it reaches maturity, they get cash from the Treasury Department, and the Fed can do can do some things with this cash. They can either take that cash, put it in a separate account outside of the game, so to speak, which is what's withdrawing liquidity from the game, from the system, from the markets, and they can put that cash in a separate account, or they can take that cash and reinvest it in new US Treasuries, which is what they're doing now. So the Fed was getting money from, or currency, not money. Money is gold, money is Bitcoin. Currency, the Fed was getting currency, US dollars, from the Treasury and putting them in a separate account outside of the game. That's true quantitative tightening in the conventional sense. But now, when those treasuries that they're holding mature, they're taking the cash from the US Treasury Department and they're reinvesting it in new T-bills, new treasuries. So the Fed isn't really withdrawing currency from the game anymore, but they're not really adding via QE either. So we're at kind of a point where when you're doing QT, that's the Fed balance sheet coming down. And you can look up Fed balance sheet and open up another window. Do it right now and type in Fed balance sheet and you'll see Fed balance sheet trends, I think, at the St. Louis Fed website. You'll see it. Go on there. You can look at the Fed balance sheet. You'll see that it used to be around like 8 trillion. And then they've taken it now in the last couple years down to about 6. Now, they're getting ready to take it back up again, and that's going to be QE. And QE, quantitative easing, stimulative, inflationary, great for markets. It's coming, you guys. So that's coming, but we're not doing that yet. The Fed is slowly turning the ship, you guys. So where they were doing QT in a conventional sense, taking the matured US Treasuries and removing it from the game, now they're reinvesting, buying more US Treasuries with it. Now, full-blown QE, which is going to come in a little bit, next few months or so, that's going to be the Fed printing fake dollars, buying treasuries, driving yields down, crowding out the private sector, which is going to make JP Morgan, Goldman Sachs, BlackRock not want to be in US Treasuries because the Fed's going to crowd them out, drive those yields down. So there's not going to be a lot of incentive for the commercial and investment banks to be buying bonds, because the Fed's going to be buying them all. So that's going to push those banks out onto the end of the risk curve. They're going to start making riskier loans. They're going to start buying riskier assets. You know, it's very stimulative. The Fed also during QE will be taking toxic assets off of bank balance sheets. So like, let's say you're JP Morgan and you're sitting on like some toxic assets on your balance sheet. Fed will come in and take those for you. That's going to free you up, allow you to, you know, act a little bit riskier and frisky with these markets. And so that's going to be QE. Now, the Fed has been doing QT last couple years. Now they're slowing the pace of their QT. That's where we're at right now. It's QE Lite. They're no longer removing currency from the game. They're reinvesting it. And then soon the Fed's going to be printing freshly printed fake dollars, buying all the bonds with them, driving the yields down, reinflating the debt bubble, pushing banks out onto the risk curve. They're going to start buying like, you know, gold, Exxon stock, real estate, NASDAQ, you know, NVIDIA shares, Pokemon cards. Probably not banks, but you might be. But they're going to start gambling and moving out onto the end of the risk curve once QE starts. So lots changed just in the last few weeks, you guys. We've gone from, oh my gosh, negative quarter GDP, slowing global trade, tons of uncertainty, markets on the line of a bear market, to recession odds are below 50%. Tariff drama's going away, QT slowing, QE's coming. We also have a rate cut coming next month, so the market guys can just smell that rate cut coming. So we're gonna have a rate cut for July, and that's stimulative. So the way the Fed can stimulate the economy, they can do either balance sheet policy or interest rate policy. Their interest rate policy has been stimulative. We've been cutting interest rates for a while now. You know, the Fed is trying to say, well, inflation's really sticky right now, so we're pushing those interest rate cuts off, like, to the coming months. Like, we want to delay them as long as possible. But make no mistake about it, you guys, the Fed is cutting interest rates. The Fed is weakening the dollar. The Fed is trashing the value of the currency and stoking more inflation. So the Fed's rate policy has been stimulative and is going to continue to be stimulative. You got another rate cut coming of 25 basis points for June, maybe a 50% chance of another cut in July. You know, the Fed is just chambering these rate cuts into the market. So that's stimulative. The Fed also has their balance sheet policy, which we just discussed. They were doing QT. Now they're doing QT without removing currency from the game. And then soon they're going to be doing QE, which is going to be stimulative. So the market can smell all these things, guys. We also have earnings that have been good. So the market had a little bit of reason for earnings to kind of prop these mega cap tech companies up over the last couple weeks. We've had Trump raising like $2 to $3 trillion with the Gulf states. So Saudi Arabia, United Arab Emirates, Qatar. They look to be interested in like some arms deals, some AI, things like that, some Boeing jets that they're going to be buying off of us. So That's pretty good for us. I mean, that $2 to $3 trillion, guys. Trump's breaking necks and cashing checks now, but man, he really messed up a few weeks ago. And guys, for the record, I'm not a fan of Trump. I had three chances to vote for Trump and never voted for him. And I don't vote Democrat either. So that leaves me, I'm that weird libertarian guy that's off voting for Joe Jorgensen or whatever. So on this channel, guys, if I ever say something mean or nice about Trump, it's not because I even want to talk about him, it's just because I have to. And if you want to know what I really think of the guy, dude, pretty neutral. Like, it depends on what day you ask me. You know, like on Monday, I think he's all right. And then by Friday, like, I hate him. You know what I mean? So I'm always going to be pretty moderate when it comes to these Democrat versus Republican psyops, because I'm not with your psyop, guys. I'm not on your team. Okay? But I'm not for the other guy either. So you can kind of trust me as like the guy in the middle. You know what I mean? So that's where we're at with that. But Trump's been raising trillions of dollars for us over the last couple weeks. And that's been really good for markets. We did have a Moody's downgrade, so the U.S. debt was downgraded. That's like, the headlines kind of freaked out about that, but it wasn't anything. Moody's wasn't introducing any information into the market that we didn't already know. So the markets have had a pretty muted reaction to the Moody's downgrade. It's kind of one of those things like, dude, where have you been? Like, you should have downgraded us in 2008. And if you weren't going to do it then you should have downgraded us in 1971 when we defaulted on the gold standard, or World War I or World War II or the Depression. Like, Moody's had all these chances to downgrade U.S. debt, but has really been stubborn about doing it until like now. Yeah, we're on an unsustainable fiscal path. Our monetary and fiscal policy is garbage and been trashing the dollar like exponentially. What, dude, you know, where have you been, kind of thing. We've been doing that the whole time. It's sort of a reason I started this channel, guys. Have you noticed I don't come out here and peddle deflation and like tell you to like save dollars and hide under a rock and wait for the stock market to crash so you can nab up those cheap shares? Yeah, it's because, in my opinion, since the inception of this channel, it's all there for you in the archive. I've been worried about the dollar being in a permanent crash, not the markets. And look what's happened. As that dollar has gone down into the right, you know, lost 99.999% of his purchasing power, this has driven these markets into the moon. This is why we like Bitcoin. This is like why we've been stacking physical gold and silver on this channel for years. It's why we like stocks, because a weaker and weaker dollar requires more and more dollars to buy that one share in NVIDIA, to buy that one Pokemon card, to buy that one gold coin, to buy that one Bitcoin, to buy that house. You kind of get the idea. So I've always been really concerned, especially since COVID, but really ultimately since 2008, that the dollar was pathological and we would be in a terminal recession for the dollar and a terminal, you know, pathological permanent recession for wage earners. Like, guys, have you noticed wages haven't budged in 20 to 30 years? They barely go up. Every year, the three major stock indices do between 8 to 15%, and wages go up 1 or 2%. We've been compounding that mechanism for like 30 years. So it's left us in a situation where a lot of people are still making $25 an hour, but 1 ounce of gold is $3,200 right now, which is pretty ridiculous. So, or one Bitcoin is $100,000, or one house is $500,000. You kind of get the problems in the currency, guys, and we've been saying that on this channel the entire time. So really, I actually think ultimately the Moody's downgrade is bullish. Why? Well, in the near term, it does make bond yields spike, and when bond yields spike, that pushes risk assets like stocks, Bitcoin, oil, gold down. But if the 10-year yield is spiking because we're using the credit card to pay off the credit card to pay off the credit card, well, I mean, initially that creates a little spike in yields and a shock to the system and a little deflationary, whoa, what's going on, a downgrade. But then look into your hazy crystal ball. If the downgrade is because the dollar's getting weaker and weaker and weaker, what do you expect the assets that are priced in dollars to do? Go higher. I mean, guys, look at the gold chart. The gold chart right now, up and to the right. Take that chart on a 100-year time frame, invert it, that's your dollar in real terms. Forget your DXY chart. The dollar chart in real terms is the inverted gold chart. And so if gold is screaming higher every day, that means your salary, your $100,000 a year salary is buying about $50,000 worth of stuff. So you're getting a massive pay cut in real terms as these markets crash up and the rich get richer and the poor get poorer. I mean, it's diabolical. It is a beast system. It's why I call it the beast system. And I'm very intentional with that. You guys, if you whittle it down past the banks, past the families, there's a demon under there. Like, I truly believe that. We're not going to get too much into theology, but, it's a beast system. And the beast system will feed. It's like satanic, you know what I mean? So the rich are getting richer, the poor are getting flushed. Like, your wage isn't keeping up. Like, there's lots to be worried about. It's not like I come out here and I'm like a perma bull that's optimistic all the time. I'm more or less a perma bull that has a lot of things to be concerned about too. But I kind of remain a perma bull. I hate saying that, because I do want to reserve the right to flip bearish when the time comes. But it looks like being a perma bull has kind of worked out, and I'm kind of a perma bull with markets on this channel, and kind of a perma bull with the dollar, and yeah, it's been going great. You know what I mean? So with regard to those markets, right now we have the 10-year yield at 4.48%. That Moody's downgrade caused yields to hang out around 4.5%. So it's also the bond yields are just saying, look, man, if inflation's going to be a lot higher, like and you're not as credit worthy, like I'm demanding a lot more of a yield on my investment. So it's kind of like the Fed is trying to mash yields down, but the free market, the firms outside of the Fed and the government are trying to push those yields up. So, yields have been kind of high, you guys, and we're going to have to see where it goes. But I will say this, we don't want to see that 10-year yield like pop up to 5% and then keep running. Like look out below for the stock market and your favorite risk asset like Bitcoin or whatever it is. It'll all get smashed if that 10-year yield were to start like skyrocketing, like 50 basis points a day kind of thing. Like that'd be a crash, because what that would be with yields spiking would be the bond bubble buckling really quick. And that would freak out all the smaller markets. The bond market sets the tone, guys. The bond market's in charge. So I don't care if you're like super into real estate or super into Pokemon cards or super into Bitcoin. The bond market is telling your asset what to do, not the other way around. So even if you don't like bonds, and we don't like bonds in this channel, we think bonds and cash are trash. We still gotta watch the bond market, because it's like the maestro for the band. It's like setting the tone. It's like that's who's ultimately in charge. That's a huge market, guys. That's a very wide and deep well, that bond market. So anyway, got the 10-year yield hanging out at 4.48%. I'd like to see it move lower, but we'll just have to see. We have the DXY at 100 right now, so the dollar is, not strong, but not really too weak. It's not like we're in the double digits for that DXY, but it's not a strong dollar either. We got the S&P 500 at 59.26. NASDAQ hanging right around 19,000, Dow Jones around 42,500. So pretty frothy, resilient markets. Really come back, guys, roaring back since this drama over the last few weeks. Russell 2000, those small caps that were beaten black and blue about a month ago, have really come back. So we're hanging out around 2,100 on that Russell 2000. Got the VIX at 18. That's telling me that markets are not particularly fearful, but they're not really complacent either. So pretty neutral VIX, nothing to write home about. We got gold at 3,292 per ounce, and we've been talking about reasons for that. Gold smells the end of QT, smells the shift to QE, smells more rate cuts, smells geopolitical tension, smells dollar weakness, smells inflation. We're like in the Goldilocks zone for gold right now, guys. Gold continues to do really well. Got silver down there at $33.21. Silver's got a lot of catching up to do. We'll see if it does. Platinum at 1,059. I think platinum, just not a buy or sell recommendation. We don't do that on this channel, but I think platinum is like, do your own research. But that, if I had to pick which one do you want to buy today, gold, silver, or platinum, I'd nab me an ounce of platinum, but I'm not, that's for you, and not everybody likes precious metals. But platinum's more rare than gold, and 1/3 the price right now. Tells me could be a there with platinum, especially at like 1,059 per ounce. Like, that's pretty cheap, you guys, at least in my opinion. We'll just have to see. Got Bitcoin hanging out at 106,000, so near all-time highs of 109,000. Bitcoin's up there, you guys, kind of up there for the same reasons that gold has been. Ethereum at 2486. So Ethereum's just hanging out around 2,500. I don't really like Ethereum, but it's the number 2 crypto, so I can't get rid of it. Solana, I do like Solana at 167. XRP, I do like XRP at $2.34. And Cardano, ADA, I do like Cardano at 74 cents. And I like Bitcoin, obviously. If you had to pick one, just go with the mommy. Bitcoin is a huge market, guys. Like, multi-trillion-dollar asset now. You can dump billions of Bitcoin onto the market and it absorbs it, no problem. Like, it's wild. It's a very large market. Still smaller than gold, though, a lot smaller than gold. Put things in perspective, Bitcoin's market cap is like 1 or 2 trillion, gold's is like 20, 25 trillion. So it's still like, 1/10, 1/20th the size of gold. So Bitcoin, I think, has a pretty bright future, but we'll just have to see, you guys. And I think one day we're never gonna dip below 100,000 again. You know, we might this time, but maybe not. Like, what if we're in a situation right now where now that Bitcoin's back over 100,000, what if we never see the 90s again? You know, that'd be wild. But I'm not saying that's necessarily going to happen, but one day I think it will. Bitcoin will pass above 100,000. We'll never go back below 100 ever again. Pretty crazy. So yeah, that's kind of what you got going on with markets, guys. Recession odds coming down, tariff drama subsiding, QT slowing, QE coming, rate cuts are coming for June, 50% chance of another rate cut in July. So that QE is coming. Earnings have been good. Trump's out raising money. Trump put out the fires that he started with his terrible policy. At least kind of put things on pause for a while. It's on the back burner. And we did have a Moody's downgrade, but, you know, like I said, tell us something we don't know about. Printing trillions of dollars we don't have and letting Congress spend billions and billions of dollars we don't have. Like, that's in the story of our lives, guys. So I'll leave you off on this. I hope you're doing well. I hope this video finds you enjoying your afternoon. You know, I hope all is well with you, and we're just gonna keep going. All right, I hope you're winning. You know, even if you're not agreeing with me, if you have a disagreement, let me know. If you agree, let me know in the comments. Like, subscribe, comment, share, whatever. You guys are awesome. You know, I got your back, and we're just gonna keep going. All right, thanks for watching. Till next time.